right? So we're going to talk a little bit today about how to plan for retirement income. So like Ward said, I'm head of the financial well-being benefit here at UK. It's a big responsibility, obviously, to be responsible for the financial well-being of not only my own household, but 16,000 plus employees here at UK, but I do take it very seriously. It's not about eliminating financial stress for me. It's about trying to find a balance between financial stress and financial well-being, right? Because a little financial stress is sometimes what gets us out of the bed in the morning on a chilly day like today and gets us to work so that we can pay the bills and so that we can keep the lights on, right? So a little of financial stress is okay. Too much financial stress can be paralyzing. And I meet with a lot of people that just don't know where to start, right? Whether it's this transition from working to retirement or just dealing with the burdens of financial life sometimes gets a little overwhelming. So I hope that I'm a good first point of contact for folks that maybe the scale's gotten a little too tipped towards financial stress, and I can help right the scale, so to speak. Financial stress is prevalent in our society. So there's a survey every year that the American Psychological Association does that talks about sources of stress, and money is always ahead of family-related stress, work-related stress, and health-related stress. So financial stress is prevalent. This particular diagram, I think, demonstrates why financial stress should be expected, especially when planning for retirement. This is from an advisor out in Utah. His name's Carl Richards, that draws these Venn diagrams on the back of napkins to try to help explain complex topics to his clients in a simple manner, right? So anytime you're making decisions that have a high degree of uncertainty, and either those are very important decisions or you perceive them to be very important decisions, that's inherently going to be stressful, right? Because retirement is a perfect example of that, right? So I turned 40 this year. There's probably another 30 years of work before I retire. That's almost 8 presidential election cycles. So you think one presidential election cycle created a lot of uncertainty? Try 8 more before I retire, right? So there's a lot of uncertainty between now and when I retire. So it makes sense that trying to plan for retirement at any stage is going to involve some uncertainties, right? And so that's going to be stressful. I don't say this to point something out that nobody already knows, right? Or that isn't already apparent. But just sometimes just understanding that it's okay to be stressed about something makes it just a little more relaxing or manageable. Yes, absolutely. So just to point out a few uncertainties specifically about retirement: how long will I remain healthy? How long can I work? Will Social Security be available when I retire? Sorry, Russ, some people still question that. How long will I live? And will I need long-term care? So there's a lot of uncertainties specific to retirement, right? And some of these, I joke with people that would make planning for retirement a lot easier if when you retired, I could hand people a slip of paper that said, here's your expiration date, or here's how long you'll live, right? Because we could just divide the amount of money we have in our accounts by the number of years we have left, and I could tell you exactly what you could spend, right? So the math would be much easier to do, but obviously for other reasons, people wouldn't want me to hand them that slip of paper as they leave UK, right? And they might ask for another one if they don't like the answer I give them, so there's a lot of uncertainty involved with retirement. So where do you start when facing uncertainties? You start with what you know. And there's surprisingly a lot that you already know about what retirement is going to look like, at least financially, because it's going to start out a lot like what your life looks like now financially. On the day you retire, all your expenses aren't going to change dramatically, right? It's not, at least not overnight. Or at least that's unlikely, right? So it may change more rapidly for some than others, but it's going to be a gradual change, a transition as you move, as you age, and as your expenses change, as your living situation changes. As those realities change, your expenses will change. So I encourage everybody I meet with to keep it simple. Right? So we usually start by talking about their income and their expenses, right? Now, some of you are maybe starting to get a little frustrated, right, or a little bit anxious about what's coming next. It is the dreaded B word, right? One of the 2 words I cannot use with my life. Now, my wife. This has to do with money. So not if you think of another B word, don't think of that one, right? So this has to do with money. Anybody? Budget, right? Okay. So budget, right? So budget and diet are the two words I can't use with my wife. I've been married for 15 years. If I start a conversation and the conversation starts to involve the word budget or diet, it's probably not going to end well, right? So yeah, so budget. Only about 1/3 of Americans follow a written budget every month. And I can tell you off the bat that the third that do have a much easier time figuring out if they can afford to retire. So I'll talk to people that have maybe made it through their whole career without a budget, and they ask me if they can afford to retire, and what do I ask to see? Their budget, right? So if that's discouraging to you, I'm sorry, but it'll be a lot easier if we can have at least an idea of your budget as you transition to retirement. One of the key differences between a pre-retirement budget and a post-retirement budget, in my opinion, is that you want to divide your expenses between what's essential and what's discretionary. Now, I encourage this for everybody that I'm helping with a budget, regardless of what they're in my office for, because if you rank your discretionary spending, it's a good idea to see if your spending lines up with your values, right? If you rank what you're spending money on from what you spend the most on to what you spend the least on, and that doesn't line up with your values, then maybe it's a call to action to do something different with your money. But from a retirement standpoint, it's really important to have a grasp on what your essential expenses are. And I talk to folks about global essentials. You know, if you feel like an unlimited data plan is essential, it's not, right? You can live without it. Despite all the pictures of maybe kids and grandkids and videos that you can see with an unlimited data plan, you could live without that, right? So I encourage folks to really think about, you know, you need a roof over your head, you need food on the table, you need the utility bills to be paid, you need transportation of some sort, possibly for work. Maybe you need less transportation when you retire if you're not traveling to and from work as often. So I really encourage people to be strict about what they consider essential versus discretionary. Not to say that as soon as it moves to the discretionary column, you can't spend money on it, but you just need to look at it a little bit differently, especially when it comes to retirement. You also want to divide your income sources in retirement, right? So this is unique to the retirement budget, is that perhaps you're going from one income source to multiple income sources when you go from working to retirement, right? So even in my house with two incomes, pre-retirement, post-retirement, I'll have my Social Security, my wife will have her Social Security, she'll have income from her retirement accounts, I'll have income from my retirement accounts. So you can see that the different sources are important. You want to look at guaranteed income and you want to look at variable income. So guaranteed income, Russ's presentation was a great example of one very important source of guaranteed income for all of us, which is Social Security, right? You may also have pensions and annuities. If you've worked elsewhere other than UK, where we don't have a pension, obviously, then you may have a pension from a previous job. And then annuities, and we'll talk a little bit about what I mean by annuities, because as soon as you say that word, all kind of context, people pull it out of context, and it means a lot of different things depending on what you're considering. But you also have variable income in retirement. You might do part-time work that isn't going to be as consistent as full-time work. You also may have rental income. You're also going to be more than likely taking some type of withdrawal from investments. So all of these sources of income are important to consider. So now our budget is slightly more complicated. Before it was just income and expenses. Now we've got 4 pieces of the puzzle. I promise that's as far as it's going to go, right? It's not going to turn into a big, huge puzzle with a bunch of different pieces, right? So this is it. Not much more complicated, but it is a degree more complicated than just a basic pre-retirement budget. So when I ask people to look at their budget, it's analyzing the budget is the next step. So you pull all that information together, you see what your income sources are, what your expenses are, and then you want to look at where are you short. So it's basic analysis, addition and subtraction. You're just going to look to see if you need to increase your income when it comes to your guaranteed or variable income, and we'll talk a little bit about some strategies to do that. Or do you need to decrease your expenses? You know, are the essential expenses the issue? Are the discretionary expenses the issue? So we'll look at that as well. So guaranteed income is really what gives your income in retirement stability. So I use the example of a 3-legged stool because if one of these legs is missing, the stool is not going to be very stable, right? But not everybody has each one of these 3 legs. Right? So I mentioned Social Security as something that we all have. to a certain extent. Some people that have private pensions through, Kentucky teachers or something like that wouldn't have Social Security to the extent that we do here at UK. But there's also pensions and annuities. So with Social Security, and Russ obviously spoke about it at length before I did, but this question of whether to take it now or later, why is that important? Obviously, if you wait, it's going to increase. So at some point, if you're looking and you're doing the analysis and your essential expenses aren't covered by guaranteed sources of income, then maybe you need to wait a little while to take Social Security so that it grows and now it will cover your essential expenses, right? So that's one strategy, is just to wait. That's not always an option, and I appreciate that. Someone may need to or want to retire earlier and need to take Social Security to pay their bills. There's obviously a bonus if you delay. And Social Security is still our best protection against outliving your money, right? So once it starts, provided that the federal government can come through on their promises, it's going to continue, right? And you're going to get it for the rest of your life. So it's a source of income that you cannot outlive. Right? So kind of the 201 strategy with Social Security is hedging your bet. If you have one spouse file at a normal retirement age and the other wait, then you've kind of played both ends, right? If both filed early, then you are going to be locked in at a lower amount, and that amount may not be enough if inflation takes off and later in retirement your expenses increase, right? So if you have somebody file early and somebody wait, that can be a good strategy for spouses. And it usually makes sense for the higher earner to wait, and this is a basic math thing. Right? If it's going to grow about 8% a year, you'd rather have that 8% of a higher amount than the 8% of a lower amount, right? And then the surviving spouse is going to collect that higher benefit as the survivor benefit. So it makes a lot of sense to do it that way. This is just a quick example of if two spouses or two people planning together have an earnings split of $100,000, but it's not evenly divided, right? One of them was a higher earner than the other. You can see where you get a much higher benefit from waiting for the higher earner if that person were to wait until 70 to collect the benefit, right? And keep in mind as well that Social Security is calculated, the benefits are calculated by actuaries. So you're going to get the same amount of payout no matter when you file if you live to your life expectancy. The big unknown is if you live beyond your life expectancy, right? And if you live beyond your life expectancy, obviously you'd like to collect more than less, right? So that's where the advantages of waiting may pay off. Another way that you can increase your guaranteed income is to use an annuity. So with Social Security, the guarantee on whether that money is going to be available or not on a monthly basis for you is provided by the federal government. With annuities, these are an insurance product. Excuse me. This is an insurance product, so the backing on that monthly income is provided by an insurance agency, right? So an insurance company is going to provide the guarantee that that money is going to be available. So it's very important whenever you're buying insurance that you buy from a highly rated insurance company, right? Because they're going to be better equipped to follow through on their promises. And you can think of an annuity as the reverse of a life insurance policy, right? You buy a life insurance policy and you pay a monthly or annual premium because you want to protect against the risk of passing away before your life expectancy, right? The reverse can be said of an annuity. With an annuity, you give up the lump sum and then you start receiving monthly or annual payments, and that's to protect against outliving your money or living longer than your life expectancy. I always get asked, or I frequently get asked, how much should I annuitize? And it's never an all or nothing decision, right? You don't have to annuitize every penny of money that you have as you transition into retirement. You usually want to figure out, again, where are you short? If your essential expenses are not covered by your guaranteed income, what's the gap? And then you can go to companies like TIA and say, this is my gap. Help me figure out how much I need to annuitize from my investment to cover this gap in my monthly income. So you want to work backwards again from your budget. This is where you can see that without the budget, you couldn't do that. You'd be shooting in the dark trying to figure out, well, this amount sounds good to annuitize, but that's why it's really important to start with that budget. This is an example, and this is from 2016, so please don't get too hung up on the numbers exactly. This is just an example of some of the ways that you can take an annuity. So you can take it on only your life, but you can also take it on life with a period certain. So this is with life and a 10-year period certain. So what that means is if you were to pass away in those first 10 years, the payout will continue to a beneficiary, right? So you're protecting against one of the biggest risks with an annuity is that once you annuitize, that lump sum is no longer available. It's been turned into an income stream, and if something happens, you can't get the lump sum back, right? So you can see where as soon as you add another guarantee to it, the income goes down. So, and again, you can also see that because of the life expectancy difference between males and females, the payouts are typically going to be a little bit lower for a woman than for a man when it comes to an annuity, but not much. I mean, you're talking, $10 in this example, a few dollars each month in income. So some pros and cons to taking the annuity, which I touched upon just briefly, but your essential expenses are covered by lifetime income. That's the real reason to take an annuity or to annuitize part of your money, is that you know that you need a certain amount of money each month to cover the essentials. You're going to subtract from that what you're going to get from Social Security, and if there's a gap there, you can close the gap with another source of guaranteed income with an annuity. The big drawback, as I mentioned, is that the amount that you annuitize is no longer available. Right? That amount's going to move out of your net worth, so to speak, and it's going to be replaced by a monthly income. Right? And the amount that you get in that monthly income, I should say, may not be inflation adjusted. You can add inflation riders to annuities so that the amount you get each month increases if inflation becomes an issue. Right? What that will do, though, is reduce the initial payment because, again, you've added another guarantee, you've added another promise that that insurance company has to follow through on now, which increase their risk exposure because they're on the hook if inflation becomes an issue, right? So it's going to lower your initial payments on that annuity because you're going to be protected, and it has the potential to increase as it goes longer. And if historical inflation numbers are right, about every 20 to 30 years, prices are going to double, right? So if you think of your parents and why they always thought that everything was so expensive, it's because they were anchored to prices when they last worked. Right? But if they spent 20 to 25 years in retirement, prices are going to about double. So things are going to be expensive by the time you get to the end of that retirement. So having some sort of inflation protection isn't a bad idea. Now, another way to do this would be to annuitize some at first, and then if you start to see a gap showing up in your essential expenses, annuitize more later. It's not a one or done, you have to do it right away, you can never do it again decision, right? So going back to where are you short, we talked about guaranteed income and ways to increase it. You can wait for Social Security to grow, you can take an annuity, and that would increase your guaranteed income. We'll talk a little bit now about variable income. What does that look like in retirement? So I mentioned other sources of variable income in retirement: part-time work, rental income, withdrawals from investments. We're going to focus on withdrawals from investments today because that's my background. I'm not a landlord or a property manager, so I can't help you with the rental income side of it. Part-time work is part-time work, right? It depends on how much of that you want to do. But my background in financial planning, we're going to focus on withdrawals from retirement because I think this is an important way that you can supplement your income in retirement. So the two poles, so to speak, of taking money out of retirement is to take it out all at once or to take it out gradually. Right? There may be reasons to do both. Certainly from a tax standpoint, if you take it all out at once and it's all added to your taxable income in 1 year, you're going to get into much higher tax brackets than if you take it out gradually. So from a tax efficiency standpoint, you're not going to want to take everything out. But there are some folks that as soon as they retire, that's what they do. Because they want to know all the money's out and it's all in the bank, so to speak, and they can take it out from there. There are some situations where you'd want to take out a larger percentage of the funds at once, and then we're going to talk about that. So like I said, you can take it all out. We talk to people all the time, with the exception of TI Traditional, which because of the guarantee has some liquidity constraints placed on it. You could call up and say, send me all the money that you can send me as soon as you retire. right? You're going to add all of that money to your taxable income for the year. You're going to get put into a much higher marginal tax bracket. So in most cases, it's best to leave the bulk of the funds in the UK plan. Now, I'm not biased just because I work at UK. I'm biased because our plan is very large, that the costs inside of our plan are typically lower than what you're going to find outside of our plan. And you can still get access to all the resources that Fidelity and TIA have to offer from a guidance standpoint while it's in our plan. So in most cases, I think it's best for folks, at least initially, to leave the bulk of the assets in the UK plan here. So everybody starts to ask as they're retiring, about required minimum distributions. You may see it abbreviated as RMDs or MRDs, minimum required distributions. So either one of those is usually the same meaning. And these are the required distributions that the IRS asks you to start taking from pre-tax accounts when you get to the age of 70 and a half. There's a really cut and dry reason for this. The IRS is tired of letting you let this money grow tax deferred, and they want to start getting some tax income from it, right? So it's pretty transparent that that's why they want you to do it. So you start dividing the balances by a factor that's based on life expectancy. They don't expect you to run out of money taking required minimum distributions before you reach life expectancy. If you reach the age of 100, I think the factor goes down to about 2, so you're taking out half the money each year. So the idea is to deplete the account over the course of your lifetime so that the IRS can get tax revenue from that. And that factor gradually gets smaller. So it starts around 26, give or take a couple of points depending on what table you're looking at. So it's around 4%, which isn't a bad place to start when it comes to distributions. And again, this is at 70 and a half, and this is required. You're not required to spend the money. The IRS cannot make you spend the money, right? They just are asking you to take it out of the account, pay the taxes on it, and you can put it into another account, spend it when you need to, not when they require you to take it out. So other ways that you can gradually take money out of accounts, you can take only the earnings. So you could look at the account and see how much it's grown from one year to the next and just take out the earnings. You're going to leave the principal intact, so that's a good thing, right? If you want to make sure that you have the principal intact for yourself for a long life, or if you have the goal to leave the principal or the bulk of the assets to heirs or to charity, that's fine. You have the principal intact if you just take the earnings. The negative of this is that there has to be earnings. And as you all know, as people that have invested in the stock market for your working years, some years you don't have earnings. So that would mean you're not going to take any money if you're using this approach as variable income that year. That may or may not be an option, right? Or that may not be something that you're comfortable with. Not going on a vacation or not doing something that's discretionary simply because the stock market goes down doesn't sound like a great idea to me, right? To be at the whim of the stock market going up or down, determining your earnings. So, but it's an option, and that's something that some folks do. Will just take the interest that the account generates. What most people do is take what's called a sustainable percentage. And the sustainable percentage is a moving target. Academics still argue about what a sustainable amount is. Economists still argue about what a sustainable amount is. I can tell you that in my nearly 20 years in the industry, the sustainable percentage has gone down by about 2% since when I started to now, for 2 reasons. 1, people are living longer, so the account has to last longer. And 2, interest rates are lower than when I started in the industry in 2000. So when I started, everybody thought 6% was sustainable. Well, now if you ask most financial advisors, will say 4% is a little bit closer. But there's still argument about whether that's too little, too much. So it's a moving target. That's why I said the pro of this approach is that the money could last. The negative of this approach is that timing is everything, right? And there's a type of analysis that both Fidelity and TIA will do, and all financial firms will use now, called Monte Carlo analysis, where they take the sequence of returns and they basically put it into one of those big bingo ball spinners. It's not done exactly that way, right? But just to visualize it, right? Like a computer takes all this sequence of returns and they randomly pull them out, right? So you have some years that are up, some years that are down, and they put together all these different scenarios. Sometimes it's 500, sometimes it's 1,000 different scenarios that they'll run. And whether you reach your goals is then reflected as a percentage of how many of those scenarios did you reach your goal, right? So did you reach your goal, and your goal in this case would be not run out of money, right? Did you not run out of money in 95% of those scenarios, or just 80% of those scenarios, or in 75% of those scenarios? And what determines success in most of those scenarios, when you actually look at the ones that fail, it's the ones where the first 2 years of retirement, the market declined dramatically, right? And then it was a long way up after that, right? So if you talk to anybody that tried to retire in 2008, it was very hard, right? Either they had to stay at work if they weren't out the door yet, they had to stay at work a year or two longer just to let the market come back a little bit, or they were looking for work after they had retired, right? Because they couldn't rely on the income stream that their investments were producing. So that's why timing is everything when it comes to what's sustainable and what's not, right? So some tips to make it more likely that this sustainable distribution, whatever you start with, is going to last. I think you want to have about a year's worth of income in cash in whatever account you're taking money out of, right? So if you decide that you need a certain amount of money from your investments each year, have that money in a money market or cash equivalent inside of that investment account, right? So you're not taking it out yet, you're not paying the taxes on it yet, but it's there and it's liquid so you can gradually take it out. And then over the course of the year, as the cash is used up, you want to rebalance the portfolio. So if when you had that year's worth of income in cash, let's say it was 1, 2, 3, maybe it's, for easy math, let's say it's 5% of the total portfolio that's in that cash account. As we draw that down, the percentage that makes up of the total portfolio is going to decrease, right? So you can rebalance from the investments that have gone up into that cash account so that the cash is available. You're kind of replenishing that bucket, so to speak, so the cash is available the next year to start taking money out of. This approach works, I think, psychologically for a couple of reasons. One, people know that the money's there, so they're less likely to make knee-jerk reactions about the rest of the portfolio, right? So if you know you have enough money for what you need to take out in cash already, you can maybe tolerate more fluctuations in the rest of the account with the stock market and everything else that's going on. Whereas if you feel like you have to sell something out of a fluctuating balance to make ends meet, you're going to get nervous, understandably so, if that balance starts going down, right? So just having a little bit of income set aside, again, within the account, I think is helpful to make sure that you can weather the storm. Because keep in mind, you might not feel like you're a long-term investor when it comes to your retirement account if you're considering retiring in the next 5 years, right? But if you retire in your 60s and you live to your 80s, some of the money isn't going to be used for 20 years. So that is still solidly what I would consider a long-term investment horizon. So some of this money in your retirement account is still going to be invested for the long term, probably in stocks because they're the best hedge we have against inflation risk, right? So just having a little bit of cash set aside inside the account, I think goes a long way to help people kind of weather the storm with the rest of the investments. So we talked about the two sources of income, right? The guaranteed income, or multiple sources, but the two types of income, the guaranteed income and the variable income. Talked about increasing those. If you're, another way to close a gap, if you're short in any one of these comparisons, right? If your essential income expenses aren't covered by guaranteed income, we can either increase guaranteed income or we can decrease our essential expenses. So popular ways to decrease essential expenses. Downsizing is probably the most common way that you see people decrease their essential expenses when it comes to retirement. I'm already laying the foundation for my wife. This is just the kind of husband I am. For downsizing, when the kids are out of the house, right? We do not need a 4-bedroom house once it's just her and I, right? So I know from my personal experience that that's a hard thing for people to do. So it may take 20 years for me to convince my wife that that's what we should do. So I'm a very persistent person. I'll stick at it. I'll stay at it the whole time if I need to, right? So this is common, obviously. Not even if your house is paid off, it may be common. It's still maybe a good idea to downsize because there are other costs that are generated or determined by the size of the square footage you have or the value of your house, right? So the taxes. If you go to a house that's half the cost, your tax bill just went down by half, right? Your property taxes. If you go to a house that's half the cost, it's going to cost less to heat, less to cool in the summers. So just keep those things in mind. That's a really easy way to lower your essential expenses. Lowering your healthcare costs is another way that people will try to cut their essential expenses. So that's one of the reasons why the retiree health benefit here at UK is so popular, making sure that you qualify for that before you retire and that you really understand the differences in waiting just 1 year maybe and what that difference will make in those essential expenses. I talk to people that say, listen, I can't afford to retire until I get to the point where I maximize that retiree health benefit, because if I retire early, my guaranteed sources of income won't cover my essential expenses. So in my opinion, that's a very legitimate reason for waiting, right? To make sure that this equation works. And then paying down debt is another common way that people will reduce their essential expenses. So there's lots of different debt that you can pay down. I consider any debt payments, the minimums, the required payments, to be essential expenses when I'm meeting with somebody. So how far away you are from retirement is going to determine if it makes sense to pay off a lot of debt or what type of debt you're paying off. I'll talk to people that are close to retirement and they'll say, I'm just a year's worth of mortgage payments away and then my house will be paid off. Well, for most folks, that's your biggest essential expense, is your housing costs, either mortgage or rent. So if you can get that taken care of, it's quite possible that your essential expenses will be covered by Social Security, right? And that's a common thing that I see. If I could divide the retirees that I meet with, or the folks considering retirement that I meet with, into two groups, it would be those that have their house paid off and those that don't, right? And I understand that a 30-year mortgage comes with 30 years of life events, right? So it's not as easy to say, oh, well, great, you should have your house paid off. Well, life has a way of happening over a 30-year mortgage, right? So, but it does make it a lot easier for Social Security to cover your essential expenses if you've taken care of that big expense. Other things to consider when they're looking at paying down debt, or whether this is a good strategy, is how much time will it take to do that, right? If we're not going to finish it in time to make a difference in your cash flow in those first 2 years, maybe there's other strategies to consider. And also, what is the cash flow result? What payment are you eliminating? What is that going to do to your essential expenses if you eliminate that payment? If it's the $100 that you're $200 that you're paying on a car, I guess I should use realistic numbers. I think the average car payment now is an astounding like $450 a month. So if you're paying off a car, less impactful than a mortgage, right? But it still could move the needle enough to get your essential expenses covered by those guaranteed sources of income. But I also encourage people to consider, if they used money to pay off debt or they invested that money, what would be the net impact on their cash flow, right? So if you had $1,000 each year that you could use to pay off debt, or you could invest it and you could get 7% a year, you want to look at what that investment would generate in the form of a cash flow, so that you can make an apples-to-apples comparison. Okay, does it make more sense to deal with the debt? Is that going to have more net impact on my cash flow? Or does it make sense to invest it? So here, time frame is everything, right? So if you had that extra $1,000 and you only have 5 years till retirement, and it grows at 7% a year, it's going to grow to about $6,000, $6,000 and change. Well, when you turn that into a monthly income amount using that 4% withdrawal rate, it's only going to provide another $20 of income. So if you could have used that $5,000, again, $1,000 a year for 5 years to pay off debt, and you eliminated a debt that had a payment of more than $20 a month, that would be a better choice, right? So you can see that the impact would be greater to your cash flow. And you can also see where time is everything when it comes to this choice, right? If I'm talking to somebody that's earlier in their career and they're saying, should I invest at 7% or should I pay off debt? 20 years, there's a much bigger impact, 40 years for sure. So you really want to look at that and see, what is the net impact to my cash flow? What makes more sense? So to sum up what I talked about today, we talked about budgeting for retirement. We talked about the different income sources in retirement. We talked about expenses in retirement. Right? So there are ways that you can manipulate most of these variables, if not all of the variables, to correct any shortfall that you have in your budget. Right? So if you have a gap in essential income, or the guaranteed income and essential expenses, then you can close that gap. There are ways to do it. If you have a gap when it comes to the discretionary spending and variable income, then you can figure out a way to do that as well. Any questions? I left plenty of time for questions because I know that this is an area where there may be general questions that people have. I think specific to your situation, we can try to table those as much as possible. Like Ward said, there's a really easy way to schedule an appointment with me right through the Financial Wellbeing website. I have cards over at the benefits table that you can pick up one of those cards. Just send me an email and I can respond with the link to schedule an appointment. That link will allow you to check my availability and schedule a meeting with me. My office is on the second floor of the Credit Union building off of Export Street, so it's a relatively convenient location with plenty of parking. So please take advantage of that. But I'd love to take some questions now if anybody has any. None, okay. Great, well thank you very much for your time, I appreciate it. And if there's anything that we can do to help, please let us know. Yeah.
I've heard that it's advantageous to leave your funds in the UK fund. The different advantages to doing it.
I'm glad you asked that. So the question was that there are some advantages to leaving money in the UK plan, and what are some of the advantages to doing that? First and foremost, I touched on it briefly in the presentation, is the cost of the investments. When you're part of the UK retirement plans, we're able to negotiate using all of our shared assets. So we have $4 billion in our retirement plans. So we can go to Fidelity and TIA and say, listen, we want costs that are appropriate for $4 billion. Whereas if you're on your own, you're going to be negotiating based on the assets that you have, right? So if you do an apples to apples comparison between the investments you have in our plan and the investments that you would buy on your own, the costs are usually going to be a little bit higher outside of our plan. But I'm glad you asked, because another very important tax difference between how the state of Kentucky at least treats money coming out of our plan versus money that's coming out of, say, an IRA. So the state of Kentucky will exempt $41,000 and change. I think it's $41,110. I don't know where they get these numbers. Roughly $41,000 of any retirement income is exempt from Kentucky state taxes. But if you take money out of our plan and your service extends prior to 1991, then there's a ratio that's calculated. And any money that's attributable to service prior to that 1990 date is not subject to Kentucky state taxes. So it's important to consider. If you're not going to take more than $41,000 in retirement income, then it may not be an issue at all. But I always encourage people to work with an accountant and make sure that they've understood the impact tax-wise of taking the money out of the plan before they do it. Again, it may be a small impact, it may be a large impact, it depends on the situation. Yes? Yes, so yeah, the question was if I could talk a little bit about long-term care insurance. So long-term care insurance has been an interesting product to watch in my 20 years in the industry. It was entirely mispriced when it first became available because the insurance companies didn't truly understand the risk exposure or how common it would become for people to need long-term care. So it's now become pretty expensive. So when I'm talking to people about long-term care insurance, and long-term care insurance, kind of the sweet spot for when people buy that is about 55 to 65 years of age, because people are starting to assess the feasibility of retiring. They're figuring out that, yes, the numbers work, unless I need to go into long-term care facility or a spouse needs to go into long-term care facility. So when I talk to folks about long-term care, I tell them that there's really three groups of people to consider. And you divide these people into groups based on the assets that they have, right? The thresholds are gray, to say the least. But below a certain level of assets, a couple years in an assisted living facility, the assets are going to be depleted and you're going to apply for Medicaid, right? So then that's just the reality of the situation, right? That particular group may not be able to afford to buy long-term care because the premium's so high, so they're just going to assume that a few years of care, I'm going to apply for Medicaid, right? Above a certain level of assets, people will say, there's no way I'm going to run out of money, even if I need long-term care, so why buy it, right? So there's a threshold there where they just are comfortable self-insuring, right? That they either have plenty of funds or they have no use for the funds that they have left over. They don't have heirs, they don't have somebody to leave the money to, so they're comfortable taking the risk. So it's the band in the middle where long-term care becomes a question, right? That they have enough assets that it would take multiple years to deplete those assets and qualify for Medicaid, and they have too little assets that they're comfortable just taking that risk. Maybe because they have heirs they want to leave a remainder to, or they have a spouse that's significantly younger. If there's an age gap in spouses, this is a big issue as well, right? Because if the older spouse needs care and depletes a good chunk of the assets, and then the younger spouse lives longer, they're not going to have access to the assets to do that. So I encourage people to look at their budget. Insurance purchases are also a very personal purchase, I think, because everybody's temperament is different. I meet people that they can't buy enough insurance. They have insurance for everything. And then I meet people that are much more comfortable taking on the risk and not insuring in some ways. So I think you want to look at your cash flow. Can you afford the premium? And how important is that to your financial situation? If it's going to give somebody peace of mind to buy long-term care insurance and they can afford it, I tell them to go for it, because that peace of mind is really priceless to know that you're protected. So the question was that there's multiple kinds. Yes, with all insurance there are multiple kinds. So you really want to look at the fine print of what your long-term care policy will cover. You know, will it cover income care? Will it cover only care in a facility? I would say the most cutting edge long-term care insurance now are these asset-linked long-term care policies, where there's a certain asset or pool of money that's linked to it. And so that reduces the premium because the insurance company is first going to draw down that asset that you have linked to it before it kicks in and they actually have to start paying for benefits. So if you're looking for less expensive long-term care, you can look at some of the asset-linked policies where it's not pure long-term care insurance, there's an asset attached to it as well. But it's definitely something that I meet with people about all the time. But that I would encourage someone to work with an insurance broker that can look at multiple policies from multiple carriers to decide what's the best option. We have long-term care here through the MPM group, so that's one avenue to consider. But you want to make sure that you're getting at least 2 or 3 quotes just for a basis of comparison. I also talk to folks that maybe have long-term care and they've gotten these wonderful letters in the mail that say that the premium's going up. Because again, like I said, the industry entirely mispriced these policies when they first came out, and that's a hard decision too. You know, whether you keep the premium the same and reduce the benefit, do you keep the premium the same and take off the inflation rider? You know, which again is a risk because this cost of this care is going up. So there's a lot of variables to consider with long-term care. Yes. Yes. Completely different. Yeah, so the question was the confusion between long-term care and long-term disability, right? So long-term care is going to provide care that you need as you age, either in-home, you know, in a facility, or you know, paying somebody, just care that you need as you're aging. Whereas long-term disability is really going to only cover if you're working and replace your income. Right, so that's the difference in those two. But you're right, they're often confused, or someone says, "Oh, I've got that," and they've got long-term disability, and as soon as they work, it goes away, and they say, "Oh, I thought I had long-term insurance." You're right. So you want to make sure you're thinking of long-term care versus long-term disability. Yes. Mm-hmm. So the question was about that tax exemption that I mentioned for the state of Kentucky. So it's a Schedule P, if you look at it on the Kentucky Revenue website, is the site or the form that you use for pension revenue. So it's any sources of our retirement plan, IRAs, that are under that $41,000 exemption, any sources of retirement income. These are the accounts that you would get what's called a 1099-R for. The R stands for retirement, right? So these are a tax form you receive when you take money out of R accounts, IRAs, other retirement accounts. Each year, you have a $41,000 exclusion, as it stands now, from Kentucky state taxes. So that general exclusion applies to our plan, but also because of changes that they made to the taxation of different pensions in the late 80s, early 90s, there's other advantages to maybe having assets in a plan where you have service, you have a service record at UK that predates that date. So that's the important thing to consider. Yes? Federal tax rate in retirement. Great question. That's a degree of the uncertainty that I mentioned planning for retirement years away, is that no one knows what federal tax rates will do in retirement. Was that your question, really, what the tax rate would look like? I guess I'm kind of antagonistic when people ask me what's better, pre-tax or post-tax. When they're asking me what's better, a Roth or a traditional IRA, we kind of get into that discussion about what will taxes be like in retirement. And I tell them if they can tell me the tax bracket they'll be in when they retire, then I can solve the equation for them, right? I can tell them which is better, pre-tax or post-tax. We really don't know where tax rates will go in the long term. A personal belief of mine is that it looks to me like we're going more the European direction with taxation, where it's going to be more of a value-added tax instead of an income tax, because I don't see a political environment for increased tax rates in the foreseeable future. So that being said, maybe income taxes gradually go down, but your guess is as good as mine on that one. I think people want to consider where they are in their current taxes, and let's say you're saving 20% of your income. That's usually a good rule of thumb, combination of retirement and other savings. You don't need to take 100% out of your retirement accounts or replace 100% of your income. You may only need to replace 80%. So if you look at where that 80% of your current income will put you in the marginal tax rates, then you may be able to see for your specific situation, how is your tax bracket going to change when you retire? That's what I would probably do. Yeah. But long term, it's hard to tell. Any other questions? Great. Well, thank you very much for your time. I appreciate it.
Okay.